So I would say the impetus to own gold is incredibly strong right now. And I would suggest that if the market does break, the impetus to own gold will increase. And there's a lot of, you can feel the interest building here. And of course, as you know, through the experience of watching financial markets, when something starts working, I mean, everyone eventually gets there and you get some kind of blow off. And I think the targets for gold, if we go up as much as we did in the last two bull runs, we have a long way to go in terms of pricing of gold and silver. And perhaps it'll be more exciting for silver in my mind.
China's central bank added more gold to its reserves in July, marking its ninth straight month of buying. Holdings rose slightly from 73.90 to 73.96 million fine troy ounces, pushing the value of China's reserves up to $243.99 billion, according to data from the People's Bank of China. This steady accumulation isn't just a local move, it's part of a broader global shift. 2 decades ago, central banks were net sellers of gold. Today, they're stacking it. Precious metals analyst Eric Sprott points out that while central bank buying has ramped up, global gold production isn't increasing and silver output is declining. The supply side isn't budging, but the demand side is. It's not just central banks. A July Reuters poll of 40 analysts and traders showed growing concern over global trade risks and ballooning fiscal debt. Investors are seeking safety, and gold's appeal is rising rapidly. The median gold forecast in the poll jumped to $3,220 per ounce, up from $3,065 just months earlier. The reason? Fiat currencies are weak across the board. The US dollar receives the most criticism, but every primary currency is experiencing erosion. They only appear strong when measured against each other. Sprott also points to runaway government spending and the growing possibility of a broader market breakdown. In that environment, the argument for gold isn't just strong, it's becoming unavoidable. There are signs the smart money sees this too. Gold mining stocks are outperforming. Institutional capital, historically hesitant to touch the mining sector, is now moving in. Technically, the GDX is showing stronger relative performance than the GDXJ. That suggests investors are favoring large-cap miners with proven reserves and solid cash flow. However, this pattern often unfolds in waves. Once the big names are saturated, juniors tend to follow. That second wave may already be building. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
I think the move in gold is easier to predict than when, the Mag 7 are going to roll over, although I suspect it's soon. And the reason why is I think gold is easier to predict because you have fundamental changes happening here where, it used to be in the early 2000s, central banks were sellers of gold. Now they're buyers of gold. And the gold production hardly ever goes up. In fact, silver production seems to keep going down. You have a weak currency, the US dollar, and in fact, every currency is effectively a weak currency. They are lucky that they all get to compare themselves to each other because they're all weak and you have irresponsible governments pretty well at every level. So I would say the impetus to own gold is incredibly strong right now. And I would suggest that if the market does break, the impetus to own gold will increase. And in fact, I always mention that the gold stocks have outperformed everything. And I always find it funny. People say, well, why don't they notice? Why don't people notice that? I always say, well, there is one group that notices. It's the computers notice. When you get the handout every morning, what's working and what's not working, and the gold and silver and gold and silver. And then finally, people catch on. And we see that amongst some of the smarter guys in the business that have committed to owning gold shares that would typically have been growth guys, but even the bond king, Grunlack, he likes gold. He can see where it's all going. He's the bond king, but he likes gold and is reasonably outspoken about it and confident about it. And there's a lot of, you can feel the interest building here. And of course, as you know, through the experience of watching financial markets, when something starts working, I mean, everyone eventually gets there and you get some kind of blow off. And I think the targets for gold, if we go up as much as we did in the last two bull runs, we have a long way to go in terms of pricing of gold and silver. And perhaps it'll be more exciting for silver in my mind. I think that I got seriously into it in 2000. I bought gold in 2000. We bought lots of stocks over that time period. And it's something that, quite frankly, as I look at it today, here 24 years later, it's still what we do. And why do we do it? Because one, we had 2000, two, we had 07, 08, 09. And now we have this other bubble that's probably going on. And what's ultimately going to happen when that bubble gives it up? And where are we going to find refuge? And it would appear to me, as I notice that the gold stocks, gold, silver, are the best performing groups so far this year. And I think it's just begun. And we haven't even had the tip over in the market yet. But I suspect that will aid and abet the interest in precious metals. I've said this before, that I think the big companies have cast a pall on the investment in gold because they have underperformed. I think Barrick used to produce 8 million ounces back in 2000. Now they produce 4 million ounces. Well, it's not exactly a formula to make a excessive return. Some of the countries have had difficulties with acquisitions that were mistimed. It's tough to find gold. If you're going to be a big company and they're going to go out and drill, the likelihood of being successful is not high, and the cost of drilling is expensive. So they kind of sit in the weeds and wait to buy something. But I'm always surprised that, I'll give you the example. I'm the chairman of Kirkland Lake. We have purchased the Fosterville mine in Australia. It's so obvious to me what kind of money we're going to make year, 2 year, 3 years out. The stock was, let's say, at $10 or $12, and nobody approached us. Nobody approached Kirkland Lake, considered buying it now that we had Fosterville. And of course, all of a sudden we started producing from Fosterville. The grade's just beautiful. And stock goes from 10 to 70 without a whimper from any company. Nobody knocking on our door. I don't get why they wouldn't. The data was there to see what we should produce. So we knew what the grade was going to be. We was right at the existing mine. It was pretty well a layup in my mind. And of course, that was a tough time for the gold stocks too. I think we're probably talking, 2015 to 2020 when everything was just awful, except for Kirkland. And it finally, I found it rather odd that I was no longer the chairman when Agnico bought it and paid no premium, which I thought was kind of weird. I suspected it wouldn't happen like that if I was the chairman, that we would sell it for no premium. Or maybe we'd still exist today and because no one would buy us. But there's lots of opportunities, but the big companies seem to be asleep at the switch. I would say that now. I have some companies that I really like, and I'm loath to talk to a big mining company about them. I don't want a bid on certain things because they're so cheap. Let's let it play out here. I might have a stock, one stock that is a favorite of mine, Free Gold, trades at $1. They just came out and said they had 30 million ounces, but they actually cut it back and said, well, let's call it 23 million, but it really was 30. And in Alaska, beside the Fort Knox mine that Kinross has everything. And it was trading at about $10 an ounce in the ground. Oh, why wouldn't somebody buy it? Why wouldn't? You can't find gold for $10 an ounce. Why? What's wrong with Alaska and 25 minutes from Fairbanks and road there and a state that likes mining, but no one's, well, I know lots of people have met with the company just to chat, but no one's ever gotten serious about doing anything, which is fine. I'd like to see the stock go from $1 to $10, and I do have probably more losses as we sit here right now, okay? I mean, I might be able to come back here 3 years from now because I rarely sell anything. And say, oh, it all worked. As the price of gold is $3,800 and everything's levitated by 500%, then fine, I'll be okay. But if I sit here right now, I'd say I probably have more losers than winners. But, and it's a very, very big but, when you have a winner, you focus. You just keep pushing. You keep pushing. And so, I mean, I have companies that own 45% of, 30% of. I got many that I own 20% of. I bought 2 this week where I already had like 13 or 15%, and I went to 20. I said, okay, it's coming together. Price of silver is going up, or this guy's got a new thing happening, and it's all looks like it should work out. And so I go deeper. I might own 300 different companies, but I put new money in 2 of them. And it's more than that. I mean, this year I probably put money in whatever, let's say 10 different companies. And of course, those 10, when it's big money, sometimes I'll just, do something to help a guy, that needs $500,000 or $1 million, something like that. But when you're writing 5s and 10s, you know that you're actually giving it some thought here, and it's purposeful. And so I am always re-looking at the things you own and what's happening here and why is that stock starting to move? And they're phoning up the manager. Oh, you got some new drilling going on. Well, okay, let me go take a look at the drilling here, and I'll, go back and review it. Okay, this is starting to make some sense. So fine, maybe I'll just amp it up a little. And that's what you do. You keep pressing the bet is what you do.
Yields on long-dated U.S. Treasuries climbed Thursday after a weak auction of 10-year notes signaled fading demand. The 10-year yield rose more than 2 basis points to 4.22%, while the 30-year yield jumped over 4 basis points to 4.813%. These moves came ahead of another key auction, this time for 30-year bonds, and followed stronger-than-expected pricing data in the July Services Sector Survey. Markets are also digesting developments tied to former President Trump's tariff agenda. The rise in yields isn't a vote of confidence in economic growth. It's more a reflection of what's not working. As Eric Sprott puts it, yields are ticking up not because the economy is booming, but because the government keeps issuing more debt and someone has to buy it. The trouble is the usual buyers are backing off. That's already visible. Japanese investors, historically large holders of U.S. Treasury bonds, sold a record amount of U.S. dollar-denominated bonds in February. The reason is simple. Hedging currency risk has become so expensive that it wipes out any yield advantage. For many foreign investors, holding U.S. debt is no longer a worthwhile endeavor. This means that the so-called safe haven status of U.S. bonds is being questioned. Investors aren't just weighing returns, they're reassessing the risk. The old assumption that treasuries are the final stop in a flight to safety is starting to crack. Let's get back to the interview.
It'll all end by something happening in the credit markets, is my guess, okay? That, we've seen the 10-year bond actually pick up a little here in yield. Because you still got to issue the bonds every quarter and week and whatever, and somebody got to buy it. Well, if the guy who used to buy some of it was the person who was a saver who's now a negative saver, he ain't going to buy any. And if the Chinese used to buy it, they don't buy it. The Indians used to buy it, now they don't buy it. Of course, the Russians can't buy it. But, there's a lot of people who now are in a position where they might regard it as being responsible to not buy the U.S. debt. That's becoming more obvious by the day. So it's going to be something to do with the bond market and interest rates and defaults, things like that. Whether the whole commercial real estate thing comes to pass, whether maybe you'll get a crash in housing prices here as people realize, they all hope that, we're going to get a cut in the Fed funds rate and housing prices will go up. Well, so far they haven't. Fannie Mae came out and said they're not, the house sales are not going up this year. They're not going to go up because people are just too stressed out already. They need rates a lot lower than they are. Well, I'm a very irresponsible investor, and I have probably 90% of my funds in gold and silver, which has gone from 250 in 2000 to 2,600 today. So it's only up 1,000%. I still and going higher. I am short some stocks in the market here, but a very small part of my total portfolio probably wouldn't. It's probably like 5% of my portfolio might be short stocks, and I've lost on them, of course. But you got to be patient. I've been short lots of things before and had them shoot up on me, only to find out that they went down. In fact, when I was re-reviewing some of the stuff I wrote back in 2007. One of the articles I wrote was Dead Men Walking. I said the following companies are broke: General Motors, Fannie Mae, Freddie Mac, Citigroup. And that was in probably 2007, 2008. They all went down to $1 a share. They got bailed out, of course. They were broke, but they got bailed out. It's amazing to think that we had the bailout of in NASDAQ, the 2007, 2008, where we get quantitative easing. And then the COVID thing, we just throw money all over the place. And in fact, even now, the governments are throwing money all over the place with no reason to have to do it. They just like doing it. So, we got a big bubble here. People should be careful. It all has to start with the opportunity. Like, why is this an opportunity? What is it about that investment that makes it interesting to you or undervalued? And I've already mentioned free gold. And I remember my partner came in and said, Eric, we've had this company that came in to visit us at Paradigm, as it turned out. And he says, they say they got 6 million ounces and the stock's trading at $6 million, i.e. $1 an ounce. I said, let's buy 25% of it. What's the name again? I knew nothing about it. And it was funny that the president, Christina Walcott, she was presenting at Beaver Creek, and she was reminding the listeners that In 2019, Eric came in and bought 20 or 25% of the company at 6 cents a share. And at the time, it was trading at 90, like now. It was trading at 90. So there's a 15 bagger right there. And now, of course, now they got 30 million ounces. And in my own mind, I can conceptualize readily that they could have 60 million ounces because they got the 30 here. And they say, we got a thing just as big over here, possibly higher grade, maybe higher up in the elevation. So my mind says, okay, it could be 60 million. Nobody's paying for it. I mean, they're only paying $10 an ounce. Not even paying $10 an ounce for the 30 million. What if it's 60? Now it's $5 an ounce. Fine. Let's keep investing. Makes it fun when it works out. You're not too many where you could go from 6 million to 30 million in 5 years, but that was the case in that situation. And I would have bought many issues in that stock. I bet I have bought 5 of them. And most of them, I would be going to them saying, why don't we do an issue here? I'd like to get a little more money in this thing. In fact, I exercised some warrants recently, a year early, which is insane from a portfolio manager's point of view. But I wanted them to have the money so they could do the drilling and not have to go to the market and get beat up doing a stock issue where, they issue it down 15% and they got to give the underwriter a warrant and a big fee and whatever, and all they do is sell it at the lowest common price. Well, you got to be a numbers guy for starters, okay? If you're not a numbers guy, you'll never even notice the anomaly because you're looking at something. You better figure it out right there, okay? Because if you want to keep looking at different companies, that's your one chance to figure out what there might be a serious opportunity there. If you miss it because, I'm afraid of math or whatever, and I'm used to doing those kinds of things. So looking at where I always look at what's the company cost me today and what should it be worth somewhere down the line. That's the payoff, okay? Now, I don't have to own the whole thing, but I know if it's, let's say, worth X and I think it's going to be worth 50X, it's going up 50 times. I mean, I may only own 10% of it, but I know if I thought something was going to go up 50 times, I'd own more than 10%. That's pretty simple.
So being analytical is very important.
Being analytical is important. I think one of the great things about being a Canadian is we focus a lot on resources. And I certainly noticed, and I'm sure many of the people who would listen to something like this would realize that the payoff in resources is outsized. It's just outsized. If you find it, the return is incredible. So that the reward to the hunt, if you find it after working hard to find it, I'm talking as an investor now, not the guy out pounding the ground with the drill core, but the guy who reads the results of the drill core. That payoff can be very, very substantial. And one of the things I find is that everyone might say, well, you're not a geologist. I say, well, I have a view of what happens when a geologist finds a big discovery. He probably, how did that get there? Where did that come from? What is that? And Eric's sitting there saying, oh my God, look at the ores worth $1,200 a ton. This thing's going to go way up here. Because you're just immediately put it in numbers. Because it's a numbers game when it comes down to it.
All across the global financial landscape, behavior is shifting. Central banks continue to pile into gold, not just for diversification, but also as a shield against weakening currencies and fiscal uncertainty. Meanwhile, institutional money is creeping into miners, signaling quiet but growing conviction that this trend has legs. On the other hand, once reliable buyers of U.S. debt are pulling back, exposing cracks in what was once seen as the safest corner of the market. These aren't scattered signals. They're pieces of a much larger realignment. How far along are we in this shift from paper promises to hard assets? And what happens when the world stops trusting the old safe havens altogether? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.